What you're about to hear will fundamentally change how you understand the silver market. The year 2025 is almost over, and when the final bell rings, silver will have posted its greatest annual performance in recorded history. Not the greatest decade, not the greatest generation. The greatest single year ever documented, 161%. That is not a typo. That is not speculation. That is the official number that will be printed in the history books. Silver started the year as a forgotten metal. It ends the year as the best performing major asset on the planet. Better than the S&P 500, better than the NASDAQ, better than Bitcoin, better than gold, better than every single currency on Earth. And the financial establishment is scrambling to explain it away. They are calling it a bubble. They are calling it speculation. They are doing everything in their power to make you doubt what you are seeing with your own eyes. But the numbers do not lie. The price does not lie. And the vaults are emptying faster than they can refill them. Let me give you the current state of play. As of this recording, silver is trading around $73 per ounce. Just days ago, it touched an all-time record high of $83.62. That means in a single calendar year, silver went from approximately $30 to over $80. This is not normal price action. This is a repricing event. This is the market finally acknowledging what we have been saying for years. Silver is critically undervalued and the world is waking up to it. But here is what makes this even more significant. Gold also had its best year since 1979. That was the year of the Iranian Revolution. That was the year the world nearly tipped into chaos. Gold climbed 66% this year. That alone would be historic. But silver outperformed gold by nearly 3-1. The gold to silver ratio collapsed from over 80 to under 60. And the analysts who mocked silver stackers for years are suddenly very quiet. Now let me explain why this happened and why it is just beginning. There are 4 fundamental forces that drove silver to these heights. And every single one of them is still accelerating into 2026. The first force is central bank buying. For years, central banks around the world have been quietly accumulating gold. Russia, China, India, Turkey, Poland. They have been converting their dollar reserves into hard assets. This year, that buying reached a fever pitch. But here's what the mainstream media will not tell you. When central banks buy gold, it creates a halo effect on silver. Because institutional money managers look at the gold price and then look at the gold to silver ratio and realize silver is relatively cheap. So they rotate capital into silver to capture the spread. Central bank gold buying is the gateway drug for institutional silver buying. And this year, the institutions finally showed up. The second force is the Federal Reserve pivot. In December, the Fed cut interest rates again. The minutes from that meeting show deep internal debate about the pace of future cuts. But the direction is clear. Rates are coming down. And when rates come down, non-yielding assets like gold and silver become more attractive. You are no longer sacrificing yield by holding metal instead of bonds. The opportunity cost disappears. Analysts are now projecting that gold could test $5,000 by the end of the first quarter of 2026. If that happens, silver at current ratios would be trading above $100 per ounce. The math is simple. The Fed is printing your future profits into existence. The third force is the critical mineral designation. This one flew under the radar, but it is massive. The United States government officially designated silver as a critical mineral. Think about what that means. The same government that has spent decades suppressing the price of silver through paper manipulation is now admitting that silver is essential to national security. Why would they do this? Because they finally looked at the supply chain and realized they have a problem. Solar panels need silver, electric vehicles need silver, missiles need silver. Semiconductors need silver, artificial intelligence data centers need silver, and the domestic supply is nowhere near sufficient. When the government designates something as critical, it opens the door for subsidies, stockpiling, and strategic reserves. This is the first official acknowledgement that silver scarcity is a matter of national survival. The implications are profound. The fourth force is the supply crisis that nobody is talking about. Silver inventories are at multi-decade lows. The comex registered category has been bleeding metal for months. Mining output has stagnated because years of low prices discouraged investment in new projects. You cannot flip a switch and create a new silver mine. It takes 7 to 10 years from discovery to production. So, even if prices stay elevated, the supply response will take nearly a decade to materialize. Meanwhile, demand is exploding from industrial applications, investment demand, and now government stockpiling. We are watching a slow-motion train wreck in the supply-demand balance, and the price is the pressure release valve. Now let me address the volatility we saw this week. Silver touched $83 and then pulled back to $73. That is a 12% correction in a matter of days. The financial media is screaming bubble. They are pointing to the CME margin hikes as evidence that regulators are concerned. But let me tell you what actually happened. The CME raised margin requirements on precious metals futures. This is their standard playbook when prices move too fast. Higher margins mean leveraged traders have to post more cash. If they cannot post the cash, they are forced to sell. This creates artificial selling pressure that has nothing to do with fundamentals. It is mechanical, it is predictable, and it is temporary. We saw the same thing happen with nickel. We saw it happen with GameStop. We saw it happen with silver in 2021. Every time prices threaten the short positions of the major banks, the exchange raises margins to flush out the leveraged longs. But here is what they cannot control. The physical market does not care about margin requirements. The Chinese buyer paying $89 in Shanghai does not care what the comex margin is. The solar panel manufacturer securing 2026 supply does not care about paper market volatility. The correction we just witnessed was a leveraged washout, not a fundamental repricing. Look at the context. Gold is on track for its best year since 1979. Silver is having its best year ever. Platinum is up 120%. Palladium is up 65%. Every single precious metal is screaming higher. This is not a silver bubble. This is a currency crisis being expressed through metals. The dollar is losing purchasing power faster than the official statistics admit. Inflation is embedded in the system. The national debt is exploding. And the only assets that cannot be printed are heading for the moon. Let me give you some historical perspective. In 1979, gold surged because of the Iranian Revolution and the collapse of confidence in the Carter administration. In 1980, silver spiked to $50 when the Hunt brothers tried to corner the market. Adjusted for inflation, that $50 would be over $200 today. We are not even close to the inflation-adjusted highs from 45 years ago, and the fundamentals today are far stronger than they were then. In 1980, there was no solar industry consuming 200 million ounces per year. There was no electric vehicle revolution. There was no artificial intelligence boom requiring silver-infused electronics. The demand side of the equation has been completely transformed while the supply side has stagnated. This is why silver is not in a bubble. It is in a catch-up phase. Now, let me tell you what to expect in 2026. Based on the current trajectory, we are likely to see silver test $100 per ounce within the first half of the year. This is not a bold prediction. This is simply extending the trend line. If gold reaches 5,000 as analysts project, and the gold to silver ratio compresses to 50, you get $100 silver mathematically. But here's the scenario that keeps the banks awake at night. What if the ratio compresses further? What if it drops to 40 or 30? At those ratios with $5,000 gold, silver would be trading between $125 and $167 per ounce. Sound crazy? It happened before. In 1980, the ratio briefly touched 15. We are nowhere near historical extremes. The rubber band is still stretched in favor of silver. The key question for you as an investor is simple. Do you trust the paper system or the physical reality? The paper market says silver is worth $73 right now. The physical market in Shanghai says it is worth $89. The gap between paper and physical is the spread of corruption. It is the distance between manipulation and truth. That gap is closing fast as physical demand overwhelms paper supply. The CME can raise margins all they want. They cannot manufacture silver. They cannot force miners to dig faster. They cannot make industrial buyers stop needing the metal. All they can do is delay the inevitable and create buying opportunities for those who understand what is happening. So here is your action plan for the new year. If you do not own silver yet, use this correction as your entry point. 73 is a gift. It might not last. The leveraged traders have been flushed. The weak hands have sold. The market structure is now cleaner and ready for the next leg higher. If you already own silver, do not let a 12% pullback shake your conviction. You just lived through the best year in silver history. You are positioned correctly. The thesis is playing out exactly as predicted. Hold your position and prepare for what comes next. The miners deserve special attention here. If silver is up 161%, the mining stocks should be up significantly more due to operating leverage. Many quality silver miners have tripled or quadrupled this year, but the real gains are still ahead. When silver crosses $100, the miners will become cash flow machines. Their profit margins will explode because their costs are relatively fixed, while their revenue doubles. This is where generational wealth is created, not by trading the metal, but by owning the companies that produce it. Let me leave you with this final thought. For years, we were told silver was dead. We were told it was just an industrial metal with no monetary future. We were told the banks had won and the paper manipulation would last forever. Those narratives died in 2025. The price spoke louder than the propaganda. 161% does not lie. The best year ever does not lie. Record highs do not lie, and the empty vaults do not lie. We are witnessing the beginning of a monetary reset, and silver is at the center of it. The governments know it. The central banks know it. The industrial giants know it. The question is whether you know it too. Because when this reset completes, when the dust settles and the new system emerges, there will be two groups of people: those who held real assets and those who held paper promises. Choose wisely. The next year is going to be extraordinary. Stay alert, stay positioned, and I will see you in the next update.